Having losses obviously suck, there is no losses that feel good. However, losses are not just a beginner's thing, and even advanced or I'd say professional option traders can have some huge losses. And in this video, I wanted to cover the case of James Cordier, who lost more than $150 million selling options. And I wanted to analyze what he did wrong, and what can we learn basically from his huge loss that he had. Because you're gonna see that a lot of what he's done that led to the fact that he lost $150 million was really avoidable. And there are a lot of beginner's mistakes actually in that case, and it's quite crazy to see that someone who was managing that much money actually did such beginner's mistake. And that's what we're going to see together in this video. By the way, this video is a bit different. Usually I share, for example, strategies that I use, results that I have, and in this video I wanted to change a bit and make something a bit different and analyze a case of someone who publicly actually lost a lot of money and try to find some takeaways here. So if you end up liking this video, you find it interesting, or maybe you learn some stuff from it, then don't hesitate to like this video and subscribe to my channel. That's really the best way of letting me know that you appreciate this type of format and content and you like to see more like this. So first of all, before we go into really what happened with James Cordier, let me run you through who is James Cordier. James Cordier was an investor and especially an option seller, and by the way, he founded optionseller.com, and that was the fund that he was using so as to invest his clients' money in the markets. So as the name says, optionsellers.com, he was mostly selling options. And one very particular thing to know about James Cordier and his way of investing in, his way of selling options, he was selling options on natural gas and crude oil futures. And that's a very important point to remember for the next part of the story. So let's just remember that he was selling options on crude oil and natural gas. So as I said, he had this fund where he was investing in the market, he was selling options. And the particular thing is that he was investing his clients' money, and I think that the minimum that the clients could invest with him was $250,000, to the point where I think he was managing between $100 million and $150 million when he was actively investing. So as I said, James Cordier was selling options, and he was mostly using one strategy that is quite famous in the option selling world. It's what we call the short strangle. So a short strangle consists in selling a naked call and selling a naked put at the same time, and that has the particularity to create a profit zone that looks like this. So what does that profit zone mean? It means that if, for example, the stock expires between your two strikes at expiration, then you're going to have the max profit. And that strategy is quite famous usually, as I said. For example, Tasty Trade uses it a lot, and I mean, it's something that I've also been using, and it's quite nice because you're basically betting that the stock is staying within a certain range instead of trying to guess a direction. And personally, when I started with options, that's one of the strategies that blew me away, because I realized that not only I could, for example, bet that the stock was going to stay or above a certain range or a certain level, but I could also bet that the stock was staying within a certain range. And I found that very, very appealing as a strategy, because I was like, okay, cool. So options really give you that flexibility. But what happened with James Cordier? We understand that this is a short strangle, okay, but what happened with that strategy, and how comes that he lost $150 million? Well, the thing with short strangle is that you're selling a naked call and a naked put, which means that you potentially have way bigger losses than what you can win. And that's quite normal when you sell options. I mean, the potential loss that you can have when you sell options is usually bigger than your max profit. That's quite normal. But the thing is, when you sell a naked put, usually the minimum where the stock can go is zero. And I'm not taking into account, cases like crude oil that went negative or anything. I'm talking in general, a stock can only go to zero at its lowest. However, when you sell a naked call, you bet that the stock is going to go down. However, there is no limit on the upside where the stock could go. For example, if you sold a naked call and the stock is now worth $10, well, if it goes to $20, then you're going to have a 100% loss. But nothing prevents that stock from going to $20 to $40 to $100, wherever it is. So if you have sold a naked call when the stock was really low, and then the stock starts shooting up, then you're going to find yourself in a position where you could potentially lose more than what you were invested initially. And that's because you don't have any limit on the upside. You don't have any upside limit to how far the stock can go up. And that's exactly what happened to James Cordier. But this is actually a mix of different things. And let's jump into actually a chart so as to show you what really happened. So right now we are in TradingView. This is a website where you can check stocks and stuff like this. And I have the chart of the natural gas. And we are in the weekly chart. So basically you can, each bar represents a week. And what we can see is that in 2018, you can see that the natural gas went from around $3 per share, $3 per contract, to almost $5 per contract. And this is exactly the movement that caused James Cordier to lose $150 million. But how did that happen? Well, you see, as I said, James Cordier was selling short strangles. So he was essentially betting that the stock, or at least the natural gas here, would stay within a range. So for example, he would bet that the stock, let's say, would stay within this range. And if the stock stays within that range, then he would have the profit. Otherwise, he would have a loss. That's a very simple example, but that's basically what he was doing. He was always betting that the natural gas contracts would stay within a range in terms of prices, and that's what we call a short strangle, and that's what you're doing when you're selling short strangle. However, there is something to know about what he was doing that probably, and actually that caused him to lose $150 million. You see, with options, when you sell options, as I said, you can have a huge loss compared to the profit that you can make. However, for a lot of people, that profit is not enough. So what they're going to do usually is that they're going to use leverage so as to increase the max profit. But of course, there is no free lunch in the stock market. If you increase your max profit by using leverage, then you're also increasing your potential max loss. And leverage is really where all geniuses fail. It's when you have too much leverage that you're going to finally get exposed to a big movement going against you, and that's where usually a lot of people are going to lose money. It's when you use too much leverage and you don't really understand the risk that you're taking that really bad things happen. And that's exactly what happened to James Cordier. So as I said, he was selling a short strangle, and to give you an example, it's a bit like he was, for example, selling a call, for example, at around that level, and then he was selling a put around that level. And then he would bet that the stock would stay within its range, or natural gas would stay within its range. But as you can see, what happened in 2018, the natural gas absolutely didn't stay within that range, and it actually went from $3 to around $5 per contract. The crazy thing is that that movement caused him to actually lose money. And when you think about it, this movement is not even like a big movement, because that movement is not even 100% gain for the natural gas. Of course, that's a big up movement, but going from $3 to $5 is not even 100% gain. For example, if it had gone from $3 to $6, then it would have been 100% gain, but here it only went to $5. But that was enough for James Cordier to blow up because he was over leveraged. He was over leveraged when he sold the call and then natural gas started going against him. Then what happened is that he went into a loss, and actually he went so much into a loss, he actually got into debt, and his clients had to pay money back on top of what they had all lost. Meaning that, for example, you had invested $250,000 with James Cordier. On top of having lost your $250K, well, you also needed to pay a certain debt, because as I said, when you sell a naked call, your loss could be greater than what you have initially invested. So that's really where, on top of having lost everything, which is, quite insane to be honest, like $100 million loss, but on top of that, having even debt to repay is actually quite insane. And that's exactly what happened to James Cordier, and that's what led to, all this apology video that I'm sure if you know a bit option seller, you must have heard about this cringe apology video. So that's by selling that short strangle and having natural gas just going from $3 to $5 that he lost that much money. But how did that happen, and how comes that someone who was managing that much money, because he wrote books on option selling, he knew what he was doing, but how comes he lost that much money, and how comes he did such a beginner's mistake? Well, I think that there is a lot of things to take away from this story and that loss that he had, because he lost everything, and on top of losing everything, he made people go in debt. But now you're probably wondering, and personally that's really what I wondered, how come someone who's managing that much money is still doing doing such a beginner's mistake, because of course, like, you know, we know that things can go wrong. We know that, you know, when you have odds, when you have probabilities of profit, you still have that 1% chance of having the trade going against you, like really bad. So how comes did that happen? Well, personally, I think it really comes down to being overconfident. And I think being overconfident really comes in two ways for people. Either someone becomes overconfident when they start winning at a very early stage of trading because they think that it's really easy and now they can make some quick money, and they start over leveraging and then they blow up. Or that overconfidence comes with time, because with years of selling options, with years of earning money consistently without having any real trouble, I guess that James Cordier just became overconfident in his abilities, and the fact that he just over leveraged himself and just blew up, not even because of a huge move. I mean, yes, okay, it was a big move that happened on crude oil and natural gas, but that was not that big of a move. Well, the fact that he blew up just because of that just showed how overconfident we can become and how grounded we need to be when we trade options. Because obviously, you know, when you win money, when you earn money by selling options, you have a bit the feeling that this is absolutely insane, this is amazing. However, you always need to keep yourself in check and know that, you know, bad things can happen. You can have a crash, you can have, for example, a 200% up move and put you in a loss. I mean, you can have all of those happening. And personally, if I had to self-analyze, I think that I would put myself in the second category, where usually I'm not really overconfident when I start something. I usually play by the rule book because I just want to win, so I don't want to take huge risks. But I think that with time I tend to become overconfident, and that's what I think James Cordier went through. He became overconfident with time because he saw that he was making money, and I think that he just, you know, got full of himself, and then he basically got over leveraged and he lost everything. And I think that the stock market is usually a great teacher at teaching you that, you know, you cannot become overconfident, because otherwise it will come back to you at some point. One very big takeaway, I think, of that story of how he lost $150 million is that you just need, first of all, to trade small. Trading small is, in my opinion, one of the most important thing, if not the most important thing that you can do when you sell options or when you trade options in general. Because the thing is, you cannot trust at 100% the trades that you're taking. Like, there's always that 1% chance that the trade, for example, is going to go against you, like, big time. And if it does, what are you going to do about it? And that's a question that is very, very important to ask, because when you start asking yourself those hard questions, you know, when you stop a bit lying to yourself and you start asking yourself, okay, so what if the trade really goes against me, like, big time? What can I do about it? How big of a loss will it be? And will I be able to manage this type of losses? When you start asking yourself this type of question, you really keep yourself and keep your ego in check. And I think that's really necessary, because it's very easy to, you know, start trading bigger and bigger as you start earning money, because you're like, okay, so if I earn money, if I had sold, you know, double contracts, then I would earn more money. But that's the best path to hell, like, literally. Like, if you start thinking like this, if you start thinking, okay, I can just increase the size and nothing bad is going to happen, one day it will go against you and you will lose more money than what you can handle, basically. And that's what happened to James Cordier. Another lesson, I think, about, you know, trading products like natural gas or crude oil is really about understanding the product that you're trading. Understanding the products that you're trading are obviously going to help you, because you're going to understand some fundamentals that drive the prices. And for example, in the case of futures, I mean, you can see some real fundamental things happening that are going to affect the prices. And usually a lot of money is being lost because of misunderstanding the product that you're trading. And you know, this has happened in a lot of cases, especially, for example, volatility products that even get delisted because they lose like 90% of their value in one day. I mean, that happens a lot. And that's where it's really important to understand the products that you're trading and at least check what they are. And especially, for example, as I said, for volatility products. And in the case of natural gas and futures in general, you really need to be careful about what you're doing, because obviously natural gas, crude oil, I mean, they're going to be affected a lot by fundamental, by macro events. And when you, for example, trade naked calls to the point where you're so leveraged that not even 100% move is going to make yourself blow up, well, you know, you need to make sure that what you're trading is actually right for you. And in the end, I think we come back more to the fact of trading small and not being over leveraged, because even if you don't understand the product, or even if you make a big mistake and you trade something that really goes against you and you had missed something, you had missed a fundamental about the product, at least if you trade small, you can always come back from it. And that's really honestly where, in my opinion, geniuses fail, is that when you trade too big, you don't let yourself the chance of being successful in the long term. Because if, for example, just 1% of the time a crash is happening, if you just take, 1,000 trades, and 1,000 trades is not necessarily a lot, well, technically you are going to experience a crash. And if you trade too big, then you cannot trade anymore. And your capital, when you're trading, is really the engine of your business. And if you don't have capital, well, you cannot trade. So in my opinion, there's really a duty of knowing what you're getting into when you trade a product. Just make sure you know what the product is. And I'm not saying that you need to do like some huge fundamental analysis on the products that you're trading, but at least having a high level view on what is the product, what does it stand for, what happened in the past for that product. Is it a product that usually, takes like 100% in a day or something? I mean, having all of those type of information is actually quite necessary, so you don't find yourself in the same position as James Cordier. There is another takeaway that I find also very, very true, and that's something that, with time I learned and I want to share with you today. When we are in low IV environments, when we are in environments where there is low volatility, I mean, it's very, very, very important to protect yourself. And that's personally why I always trade credit spreads when we are in low implied volatility environments. And the reason for that is that you never know what can happen. And it's in the low IV environments where lies the biggest risks. Because it's when nothing happens, it's when no one expects a crash that you can really hurt yourself. Because when you trade options in a low IV environment, you need to sell options that are very close to the stock price, because there is less premium, so you need to get closer to the stock price to get some good, decent premium. And when you have a crash, when you have something that happens, then the volatility expansion just spikes, and you just get yourself into a big loss if you don't protect yourself. Hence why I like to trade credit spreads when we are in low IV environments, so at least I'm sure that I'm protecting myself in case of a crash, or in case of a big move like this one. And the thing is, had he traded credit spreads, or at least called credit spreads in our case of the natural gas, he would have never ever been in the position where he's been, like literally in the span of 3 days. In the span of 3 days, he went from managing $150 million to losing everything and putting his clients in debt. And that's very important to understand here, and I think that's a good example of how quick things can change. If we remember, for example, the COVID crash, like in March 2020, I mean, we remember the intensity of the crash and how in the span of days you can lose so much money. That's why, for me, in my opinion, the stock market is a great tool to generate, returns, and it's amazing, but you always need to be careful. Like, it's not your best friend. The stock market is definitely not your best friend, and if you trade too big, one day you'll blow up. That's for sure, unfortunately. So I hope that video was quite interesting. I mean, I think that example of how someone with that much money can still manage to blow up his account is just a very good example of how, regardless of how much money people have, what really matters is basically, are you overconfident? Are you trading too big? And we always come back to the same things in the end. Regardless of how much money, how much capital you have in your account, like the same mistakes are going to make someone lose $1,000 or $150 million, like in the case of James Cordier. And in the end, you always need to keep your ego in check, and regardless of how much money you have, you are not like invincible. Like, proof is, he lost everything. And of course, some people would probably say, like, okay, but this happens like once in a while, or once every, like a tenth of thousands of trades. I mean, this really doesn't happen often, but you just need once to actually lose everything. You just need to have one occurrence to blow up everything that you've worked for. So is it worth it? Personally, I don't think so. Hence why you can go for safer options like credit spreads, where you are going to at least have your capital protected. So I hope that you enjoyed that video where I share more about James Cordier's story and what he was doing, and basically how he lost $150 million, and what you can take away from this story so you don't do the same. If you have any questions, just don't hesitate to comment it below. I'll be happy to answer any question that you might have. Please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.